Well, hey everybody, and welcome to my live Q&A. It is Monday, the 15th of July. We are officially, a little over 2.5 weeks into the Dream for All voucher redemption period, and have lots of people with lots of questions. And so I thought I'd really open this up as a general forum and help answer any questions. So regardless of what platform you are watching on, this is all about you. I've got some things that I thought I'd bring up if you guys don't have specific questions, and I want to address some things I've been seeing, but I want to start by putting it out there and say, hey, if you have any general questions, whether it's now, whether it's as I'm in the middle of talking, this is all about you and answering your questions. So whether you are a voucher winner, whether you're on the wait list, whether you have questions about just the general process or lending questions, my goal really is to give you as much information as I can right now so that you can be successful in the home buying journey. So I'm going to go ahead and kick off with a couple of questions that I know I've gotten a fair amount of times. And so I want to start with home warranty. So CalHFA mandates that you have a 1-year home warranty when you do a Dream for All loan. As a matter of fact, CalHFA requires that on any type of a loan that you do. So if you are doing with CalHFA, if you're doing a Dream for All loan, if you are doing a My Home, any type of down payment assistance with CalHFA, their thinking is you're generally putting all of your money towards buying a home because you're using down payment assistance. You likely don't have a lot of extra money, and they want to make it a smooth process for you in the first year to not have as many repairs that you might have to worry about or not have expected. And so they are not giving anything. They're mandating that you get a home warranty. Now, the question is, who pays for it? How much does it cost? How do I pick a home warranty company? So there are multiple home warranty companies out there. Home warranties are good, but they're not perfect. Like you're going to have horror stories about all of them. The truth is, look, they cover major things that they can prove worked when the property was purchased, and they stopped working after the property was purchased. But they're also an insurance company. They're going to look for loopholes to not pay. And so that's something you have to be aware of and prepared for, is that with a home warranty, it's not an automatic we're paying for everything, but it does help you to avoid issues where something goes wrong in the house and you don't have to come up with a huge amount of money to fix a water heater or the dishwasher or something like that. Your real estate agent is your expert in picking the home warranty. They know all the different home warranty companies. They know the different plans. The rule is simple. You just have to have a 1-year home warranty, and that's it. So where you get it from, who you pick to do the home warranty, that's really up to your realtor. How much with you and your realtor, who pays for it is negotiated as part of the contract. So when you're writing your contract, you want to ask the seller to pay for it. If the seller isn't paying for it, then you're paying for it. Sometimes the realtor offers to pay for it. You gotta be careful. I mean, I'm not telling you your realtor should pay for it. I'm saying that I've seen realtors in the past who have said, hey, the seller won't pay for it. I'll kick it in for you. It's case by case, okay? But somebody's got to pay for the home warranty. All right. I want to talk about a big topic. By the way, questions, this is all about your questions. So if you have questions, post them into the comment section of wherever you are watching, and it'll come up and I can pull up your question and answer them live. So I want to talk about homeowners association fees. This is a pretty big one that I've had 3 or 4 clients recently, including one just tonight, who I guess I didn't do a good enough job, and I'll take full responsibility. And they didn't know the questions to ask. And let's be honest, you're all first-time homebuyers and first-generation homebuyers, which means your parents didn't just do this, and you're not leaning on someone. And I get that. And I apologize that I wasn't clear enough that a purchase price is not a purchase price. Okay. If I say you qualify for $500,000 and we didn't talk about it being a property with a homeowners association, then you qualify for $500,000 based upon no homeowners association. So really what I'm talking about here is a maximum payment, not a maximum price. And it's something that I'm working on creating a spreadsheet for my clients so that I can give it to you that says, hey, this is the highest house payment you're allowed. That number is a fixed number. The only thing that would change that is if your income changes, if your debts change, or if your credit score changes. So if you don't get a pay raise or a pay cut, if you don't go open up new debts or charge up any credit cards, and you don't have any issues with your credit score changing, then the amount you qualify for is a fixed payment, and that payment is not going to change while you're shopping for a home. But other things will change. I already see one question. I'll get to it in just a second. Other things will change, such as the interest rates, such as a great question, Yassine. I'll get to it in just a second. I actually have good information, and I'm going to open up my email while I'm waiting to answer your question so that I can actually give you some better information on that. So I'll hold off on the question until I have my email up. All right. So you are qualified for a maximum monthly payment, and it's really this simple. You look at how much income you make. Now, the income calculation is the income that I calculate, not what you calculate. But once I figure out my income calculation, let's pretend you make $10,000 a month. Then, depending upon your credit score, you are allowed to spend either 45 or 50% of that number. So if you make $10,000 a month and your credit score is below 700, you can spend $45,500 a month for a house payment, credit cards, and car payment. Now, if when you applied, you had no credit cards and no car payment, then the entire $4,500 can go towards your house payment. If you applied and you had a $500 car payment, then you can only spend $4,000 going towards your house payment. That number is a set number. Now, if you paid off that car and you no longer have that $500 a month payment, now you can spend $4,500 a month. But that total between what you pay in monthly payments for things that show up on your credit report and your mortgage payment cannot exceed a certain number. That is your maximum total debt you're allowed. Okay. So when we take that total number of $4,500, we subtract your $500 a month car payments, then you're allowed to spend $4,000 a month. Now, if I said, hey, $4,000 a month, that's basically a $500,000 home. I'm not giving that as real math. I'm giving that as pretend math. And now you want to buy a home that has a $300 homeowners association. Then that means your payment would be $4,300. And you get $4,000 house payment for $500,000. $300 for the HOA is $4,300 plus $500 for your car makes it $4,800. And that's too much money because you could only qualify for $4,500. And so what you have to look at is you have to look at what is your total allowable mortgage payment. And I will be giving you that number when I pre-approve you. Anybody have pre-approved already? We've kind of talked about this, but I didn't give it to you as explicitly as I'm going to do it in the next couple of days. But bottom line is, hold on, I'm pulling up that email right now. Bottom line is that you are fixed at the total payment you can have. And so if you buy a house that has more expensive other components, more expensive property taxes, because you're buying a new home that has what's called Mello-Roos. Mello-Roos is essentially high property taxes. And so you have those higher property taxes, you're going to have to put either a bigger down payment or buy at a lower purchase price. All right, so I'm going to give you a way to calculate the monthly payment. Yassine, I will get to your question, I promise, but I'm going to first show you a tool on how to calculate your monthly payment. So I'm going to go right here and let's see if I can zoom in on this at all. Kinda, not too well. All right, so I'm sharing from my phone. So I'm trying to stream my phone to my computer so that you can see my app, my phone app. Okay, so what you're looking at here is you're looking at the mobile app for my phone, for my loan application. So if you've already done an application with me, you have this on your phone. If you have not, the QR code right up there will get you to the mobile app. So if you download my mobile app, yes, you do hear a kitty. My kitty is in the other room and she wants to get out. She wants to jump on my lap and crawl across my desk as I'm talking. And I'd rather not have the interruption, but clearly the sound is there. All right. So, and Kathy, I'll give Kathy credit for that. Kathy says she hears the kitty. So thank you, Kathy, for pointing out the kitty. All right. What you need to do, go to the calculator. So I'm tapping the calculator button on my mobile app. Okay. And if you want to get here, you can also go to app.johnloanking.com, app.johnloanking.com. You can get to my webpage. You'll be able to download my mobile app right there. It'll text you the link. If you have a hard time getting to it, give me a call or send me an email and I'll send you the correct link. Bottom line, you're going to click right up here where it says new purchase, because you're not refinancing, you're purchasing a home. So I'm clicking on new purchase. Then you're going to click conventional, because we're not doing an FHA, jumbo, rural housing, or veterans. We're doing a conventional loan. This is where you have all of the important information. Okay, so this is where we're going to be able to calculate your monthly payment so that you make sure you don't exceed your payment. So let's pretend that I said the highest payment you can have is $400,000. So the first thing you're going to do is you're going to skip this top one, and you're going to go to the second slider, and you're going to change that to either 15, 20, or 25% down, depending upon one of the three ways you want to use the money. So most people, let's just start with the pay your own closing costs. We're just going to call it 20% down. So I slid that over to say 20% down. Now you might say, John, I don't want to buy a $100,000 home. I know, we'll get to that in just a minute. Okay. Interest rate. You're going to get that from CalHAFA's website. I'm going to show you again right now how to get there. So you're going to go to calhafa.ca.gov. And when you get to CalHAFA's website, you're going to scroll down, you're going to lie and pretend that you're a lender or a real estate agent. And you're going to click the button right here that says rates and reservations. Nobody's going to get mad at you. You're not going to get in trouble for going here. And you're going to click this button right here on the left that says view today's rates. So we're going to look at today's rates. And you're going to scroll down to the fifth one on the list, which is the Dream for All conventional loan. And depending, for most people, just calculate it on the standard rate lock. I would let you know if you're under the low income. So it's 6.625. Changes daily, and you can't lock it in until after you have an offer accepted on a home. But you got to project. And so you pick that number, maybe round up a little bit. Maybe you want to make it 6.75, just to be safe. So I'm going to type in my calculator right here, 6.75. Okay, so I'm done with that one. Now I am going to, the property taxes, leave them the same. The homeowner's insurance, leave it the same. And I'm going to pretend for a moment that we don't have any HOA. Okay, so you can change the state. It really doesn't matter. It's not going to change the calculation. And then I'm going to scroll back up to the top, and I'm going to slide this down, and I'm going to move the slider right here, right on the top. We're going to move the slider over until I see a payment of $4,000. So I'm going to keep going, because you qualify for a maximum monthly payment. So right about here, remember it's a slider, so it kind of trips a little bit one way or the other. So we're 620,000 is a little bit too high, but 605,000 is right about there. And I can actually tap right on here, and I can type in 610. And 610 is right about there. Maybe I can go a little higher, but let's leave a little bit of wiggle room. So now I have a payment of 600, or purchase price of 610. Remember, the most we can spend in this scenario is $4,000. That's the number you have to get from your lender. If I'm your lender, we're going to get you that number that says this is your target maximum payment that I will let you spend. So now you say, great, I want to buy a $600,000 home, and I want to buy a house in this condominium association that has a $450 HOA. And so I type in $450 in the HOA, and I hit done. And now I scroll back up to the top. Guess what? My payment just went up to $44.28. I no longer qualify for a $610,000 home in that subdivision, in that complex, because of the homeowners association. So I have to move my slider back down some and say, well, at $575, it is still, oops, well, that's great. All right, well, let's go back here. Did I ruin it? Nope, I'm still good. All right, so at $575, I am still too high. Remember, I was at 610 with no homeowners association. But when I added that $450 homeowners association, I'm now looking at maybe, it's kind of sensitive, 545. Type that in there. Yep. So 545,000. So you said, John, I am approved for 610. Why am I not able to buy a condo or a property with a homeowners association at 610? Because I have to include the HOA in your total payment. If your total payment was $4,000 is what you qualified for, you didn't qualify for a price of a home. You qualified for a monthly payment. If that place is in a flood zone and you have $150 of flood insurance, then we have other expenses, and that's annual, so that actually isn't a good way to look at it. So $150 times 12 months, we're talking about $1,800. So now You go back up here and that's $41.54, $150 a month. So I'd have to go back down a little bit more in purchase price to be at $4,000 a month, about 515 grand. So this is critical. This is really, really important for you to understand that you are not qualified for a price. You're qualified for a payment. And if rates change and the rate goes down to 6.25, then for that same price, your payment just went down, which means you could go to a higher price. So it's all of the variables and all of them are right here on my app. So you need to download my mobile app so that you can get the correct calculation. And I'm going to make sure, let's see if I have a better, that's fine. That's probably the easiest one. Is this one any better? No, it's the same one. All right, fair enough. Okay, so let's stop sharing this right now. And let's go to the questions that I've got. Remember, guys, questions. This is all about your questions. All right, so Yassine, you were the reason I'm staying up late tonight to finish your pre-approval. Happy to get it done for you. Thank you for trusting me to guide you. All right, so you're asking how much does it cost to buy points? It is different every single day. So the amount of money that you are paying to buy points changes daily, and it depends on whether CalHFA is going to offer it. And it depends on, that really has to do with the market and what the rate market is doing. And I know that's super vague and unfair for me to say that, but that is really the truth. And so I'm going to give you a quote that I got last week on Tuesday. So I had a client who wanted to look at buying down the interest rate. Now they were locked in at 6.875. And these were the options to buy down, actually they locked in at 6 point, I think it was 6.75, right around there. All right, so I'm going to share my screen and show you what those buy down options look like. Keep the questions coming, guys. I want to make this about you. So whatever questions you have, ask them. I'm going to get to them in the order that they're coming in. So let's look at this right here. All right, so let me make this a little bit bigger. What this says is that on that day, we zoom in, there you go, CalHFA was going to let that client buy down by as much as 1.5%, but it was going to be very, very expensive. So what they were saying is, hey, you can get to 6.625 and it's going to cost you 0.5% to get there. 6.5 is a total of 0.725%. So let's think about this. On a $500,000 home, it's going to cost you $2,500 in order to save 0.25% off of your interest rate. If you wanted to save 0.5% off of your interest rate to go to 6.25, you were going to have to, that's an eighth, you were going to have to pay 2% of your loan amount. So the difference between each tier is not the same. For this day, going from 6.25 to 6.125 costs an extra 0.25%. But to go from 6.125 to 6 costs an extra 0.5. In some cases, it's even more expensive. Up here, to go from 5.5 to 5.375 costs you 5/8%. So sometimes it's as little as 1/4. Sometimes it's as much as 5/8% to go up, to go down the rate stack. It can get very, very, very expensive. And the sooner, first of all, where are you coming up with the money? You can use your Dream for All money to pay for this, by the way, but I'm still trying to figure out from a compliance perspective, there are limits to how much we're allowed to charge you in fees. And I don't know whether they're going to let us pass this along to you. You can for sure ask the seller to pay it, but it's a tough market to get a seller credit. So be careful about expecting that. So this is not the same every day, but this gives you an example that on a day when rates were at 6.75, to get to 5.25 was going to cost 6.25% of the loan amount. Okay, to get to 5.5 was going to cost 5% on a $500,000 loan. That buy down was going to save you 1.25% per year. Think about this, saving you 1.25% per year, but you're spending 5% to do it. And you're probably financing that into the loan, which means that you're borrowing extra money to pay for it, which compounds the cost. I am not a fan of this unless you barely didn't qualify and we have to buy down to get there, or you have a large seller credit. By the way, 3% is the most we're allowed to get from the seller as a credit. So Yassine, this was a great question, and I appreciate you asking that question. All right, so Dom's asking a more complicated, loaded question. Dom's question, and as a matter of fact, Sunshine's question was very similar. Dom says, should I offer a flat rate to my realtor? Okay, so I'm going to give you an answer, and I'm going to tell you that this is all part of what's happening with the changes, and I think it's good. I think it's good that negotiation is coming into play when you're working with a realtor and you need them to justify their cost. Now, I'll give you a real life example of this earlier today. I was talking to a client and I was explaining everything about how we're going to qualify them. I was giving them different ways to prove their income. And I was explaining to them what, and this was not for a Dream for All loan, but I was explaining to them how I was going to be able to navigate them through this program and help them make it happen. And they said, hey, John, that's great. But I'm just curious, some other lenders are saying that they'll charge less in fee for the same deal today. They're going to charge me $1,000 less in fees than you're going to charge. Will you lower that fee? And my answer was simple. And I said, no, I won't. And here's why. Because I believe my fees are competitive. And I believe that as an expert in what I do, I'm worth what I'm being paid. If you want to go try to work with somebody else who may or may not have the same amount of knowledge as I do, go for it, and you can cross your fingers and hope. But I've taught you a lot of things today that you told me you didn't know and you hadn't heard from other people, and I believe I'm worth that extra $1,000 in fees. And so it's your choice. If you had an attorney, you need to go hire an attorney to handle something for you. Do you want the best attorney or the cheapest? Because you're never going to find the same person that is both the best and the cheapest. So Dom, the question is, maybe it's a negotiation. That client today tried to negotiate with me, and I'm okay with that. I explained that, no, I'm not going to do that. And they decided they're going to stick with me. And that was their decision. You can offer a flat rate to your realtor. You can offer to your realtor to say, I will pay you X number of dollars for helping me. Your realtor can say yes, or your realtor can say no. If they say no, then you decide, do I want to look for another realtor, or do I believe this person is worth what they're charging me? It is no different than any other product or service that we are buying. It is no different than anything else that we are doing in life, which is you get what you pay for, and it's okay to go. I don't want to give any bad examples, but it's okay to buy clothing at the Goodwill. It's okay. There's nothing wrong with doing that. It's not, I mean, you know what you're getting. I don't know how else to say it in a different way. It's okay to go buy clothes at a Nordstrom's, and it's okay to go buy clothes at Ross. Like you're paying more. You're getting the same pair of Levi's jeans. The question is, what's the experience you're getting? What's the expertise that you're getting? So you have to ask that question about your realtor. In the end, you're getting the same house. The question is the person that is guiding you. If they are willing to say, you know what? Yes, I will do that, and I'm happy to do that for you. Great. If they're not willing to, then it's your choice to say, do I want to work with this person anyway because they're worth it, or no, it's not worth it and I'm going to go somewhere else. All right. On a similar note, guys, this is all about you. This whole time is dedicated to you. I have things that I can talk about, but I want to make sure that you get your questions answered. By the way, if you just joined and you missed the first part, go back and watch this again, because the calculation on your monthly payment is critical that you understand that. The fact that you qualify for a monthly payment and not a purchase price is critical. Watching the video demonstration I did about 10 minutes ago is critical to understanding how to know how much you should write an offer for. All right, so Sunshine, are all existing listings going to keep the buyer's agent commission as is? I don't know. There was a listing agreement signed. That listing agreement, I actually read something. These rules are changing all the time. I read something that said there is an amendment or an addendum that will be signed by sellers that signed a listing agreement before August 17th that makes them compliant with the rules post August 17th. So I haven't read it. I don't know what that addendum says, but Sunshine, what that tells me is that the California Association of Realtors recognizes that it would not be appropriate for current listings to continue being marketed the way they're being marketed. It is therefore necessary to change the agreement. That doesn't mean the seller isn't willing to accept a request to pay. And I'm getting lots of questions about commissions, and I'm happy to answer them. Let me just say this. Actually, let me go to F Sharp's question. Hey, F Sharp. Curious, should or should we not thinking about buyer's commission in our closing costs? All right. I heard from a couple of industry experts recently, and I love how they said this, and they're calling it the consumer-centric model for real estate commissions. And here's what should be happening on both sides. In a conversation with you and your realtor, as the buyer, you should be negotiating your costs. You should be saying, just like what you said, what Dom and I were talking about, hey, should I offer a flat fee? Just like, what we're saying right here about how much are we offering in commission, you should be having that conversation with your agent, regardless of the property you're buying. And yes, it can be a dollar amount. It's allowed. It's in the forms. Yes, it can be a percentage. You're also negotiating if you are exclusive or non-exclusive. This is something new that I learned, and I saw it in the California draft. I am not an attorney. I'm not a real estate agent. I'm not giving real estate advice, and I'm not giving legal advice. Okay. That having been said, don't ever say John King told me, and I'm going to sue him because he told me this. I put all my disclaimers out there. So you are negotiating with your realtor, and you can sign an agreement that says I am exclusive to them. If I buy anything in this time frame, I'm paying them. Or you can sign a non-exclusive agreement. A non-exclusive agreement is kind of the same way it is today. The only difference is you've agreed to your fees up front. You're not marrying that realtor. What you're doing is you are saying, hey, if you show me a property, you were involved in showing me that property. Not just that you emailed me a copy of the listing. It literally spells this out in the version of the contract that I saw. It says, just because you put me on a drip campaign and you emailed me the address of that property does not make you involved. But if the realtor was involved in showing you and touring that property and talking to you at length about that property in particular, and you buy it, you must pay them the agreed upon commission that you guys set in your commission agreement. You can have multiple non-exclusive buyer's agreements with multiple real estate agents. There's pros and cons to that. I'm not telling you to work with multiple realtors. By the way, if you have questions, post them because I'm going to keep going down. Once I run out of your questions, I'm going to run back to what I have to say. So you can have multiple realtors working for you. I am not telling you that's a good idea. In general, I think it's a horrible idea. But what about when you first meet a realtor? Day one of meeting a realtor, you should not. Okay, I got to stop and say this. Alonzo, I appreciate it. Alonzo, you're amazing. I appreciate you. Alonzo used me last year to buy a home. John King is worth it. Thank you. I appreciate that. I am competitive, but I appreciate it, Alonzo. And I'm super happy to see you guys in that home. And that was definitely an experience helping you make that happen, a memorable one for all of us. All right, let's go back. Thank you, Alonzo. All right. So if you first meet a realtor, do you want to sign an exclusive agreement that says, hey, the first time you show me one home, I'm committing to work with you for the next 2 months or 3 months? No, you don't know if that's the right person you want to work with or not. Is it reasonable for you to sign a non-exclusive agreement? Yes. Now, if you know that's the person you want to work with and you want to get priority service from them, some realtors are going to say, look, I can only give priority service to buyers that agree to work with me exclusively. Now, I don't know. Each realtor gets to create their own menu of what it looks like, what you get from them. If I was a realtor, that's what I would say is, hey, if you're exclusive to me, I return your call first. I take you to see a property before I take anybody else to see a property. I show you the new listings immediately because you've agreed that you're only working with me and I am making you a priority. If you don't want to be exclusive to me, that's okay. But I'm not going to bump somebody else for you. If you want to go look at a property today, I'm not going to bump. There might be somebody else who's not as good at what they do and not as busy that's willing to do that. And the question is, do you want half the representation? Do you want half the quality of service? That's what I would be saying. So you have a choice of exclusive or non-exclusive. make sure you're aware of that. Make sure you're talking to your realtor and getting the pros and cons of being exclusive versus non-exclusive. And the first time that you meet with a realtor, I wouldn't be jumping in bed with them for life. I wouldn't be signing an exclusive agreement with them. And so that's something really, really important to understand. Now, this consumer-centric model, you sign the buyer's agency agreement, you agree to pay your realtor $5,000. I'm picking a fake number. Okay, you agree to pay them $5,000. Now, separately, the listing agent is talking to the seller and saying, hey, you're going to pay me X dollars, X percentage to sell your home. We're not going to talk about how much you're paying to the buyer. That is separate. You're going to pay me this amount of money. Now, if you want to attract the most buyers, you want the biggest opportunity to get in front of the most number of buyers, and you want to sell it at the same price as this other house sold a month ago, that house paid X percentage in commission to the buyer's agent. Now, I don't want you paying commission to the buyer's agent. What I want you to do is I want you to say that you're willing to give X percent as a concession. And so they can advertise that concession if they want to make it more attractive for people to come find their home. Or they can just be aware that some buyers are going to ask for it. And then when the buyer writes the offer, the buyer says, hey, I'm willing to pay. It doesn't matter, by the way, what the seller says the price of the house is. You do not have to pay that. There is nothing written ever in the world that says you must pay what the seller wrote as a listing price. There's also nothing written in the world that says if you pay what the seller wrote as a listing price, you're guaranteed to get the home. The price of the home is based on what the market will bear. It might be higher. It might be lower. It might be exactly the same as what the seller put it on the market for. But it does not mean you have to pay exactly that price or that you're going to pay exactly that price. Why does this matter? Because when the seller says, hey, I'm willing to sell this home for $500,000, you say, great. And I'm willing to buy your home for $500,000, but I need you to agree to pay this $5,000. And so your realtor writes in the agreement that says, hey, this offer of $500,000 is part of the offer is that you are willing to pay $5,000 or whatever your agreement with your realtor was. So it's now part of the negotiation. If somebody else writes an offer for $510,000 and they ask for $10,000 to pay their realtor, that's a better deal for the seller. 510 minus 10 is 500. 500 minus 5 is 495. If you were the seller, you'd take the bigger one. But if somebody said, hey, I'll give you 505, well, that's more than your 500. But they want $15,000 to pay their realtor, then the seller's only getting 490. Your deal at 495 is better. This is part of the negotiation, no different than who pays the title fee and the escrow fee, no different than who pays for the home warranty. It's all part of the negotiation. And so in the end, you've agreed to pay your agent X amount of dollars, and then you're telling the seller, as part of my offer, I want you to pay it. The seller can counter offer you. You can say, hey, the seller says, nope, I want $500,000 without paying your realtor. Okay, then how about if I give you 505 and you pay the 5,000 for my realtor? Does that make this now a worthwhile deal? It's a negotiation. So yes, you should start thinking about it in your negotiation. I don't think now it's going to depend on what type of market we're in. Are we in a seller's market or a buyer's market? Okay, so a seller's market says that homes are flying off the market immediately and the seller is in control and the buyer has to do whatever it takes to get their offer accepted. That was 2020 and 2021. A buyer's market is when there's a lot of homes listed for sale and the seller is praying and hoping that somebody writes an offer because properties are sitting for a while. And a neutral market is somewhere in the middle. So if you're in a seller's market, you're going to run into having a deal F sharp with how do I come up with my buyer's agent's commission, because there ain't no way I'm going to get a seller to pay for it. That was no different than in 2020 and 2021 when we had buyers that said, John, I can't come up with my own closing costs. Can I ask the seller to pay for it? And the answer is absolutely, but your chances to get an offer accepted are this big because there's a whole bunch of offers being written on those homes and those people couldn't buy homes in that market. And so for people who can't afford to pay for their own realtor, it's going to be hard to buy homes in that market. We're not in that market right now. The market we're in right now is kind of a balanced market. and a little bit right now leaning towards the buyer's favor. We're seeing homes sit on the market longer this summer. We're seeing sellers willing to offer concessions. That's a really good opportunity to be able to negotiate with the seller. And so I think it's critical to understand, yes, you should be thinking about it. I don't think that you need to plan for, oh my gosh, I have to pay for it out of my pocket. It can be part of the negotiation. As long as you have willing sellers who realize that this market is not a crazy hot market where nobody can get an offer accepted and that sellers are completely in control. So there's a lot of moving parts there. All right, let's keep going. Hopefully answer this question, guys. Keep asking them. Yassine, you're welcome. Maria says, John, thanks for the insights. If there are savings when people buy with less than 150,000, will that immediately create a new voucher and the waitlist number will move? Maybe once they close escrow. Not clearly. I had a buyer who was in contract, came to me last week with a contract, decided to work with me, and then canceled his escrow. There were problems that he decided that wasn't the right property for him and switched to a different property. So CalHFA won't, the extra money isn't available until the escrow closes. But I think it's going to be kind of an accounting challenge. If I was in charge, I would wait until the 90 days is over. And I'd say, okay, as we approach the end of the 90 days, we at one time can say, okay, how many little chunks of money do we have left over? Let's ball them all up like we do with cookie dough, and let's divvy them out again and give a bunch of additional vouchers at that point. That's a simpler accounting process. They have not explained whether they're going to do it immediately or whether they're going to do it quarterly, like I thought would be the easiest way to do it. But either way, you're definitely going to get access to that additional money. It's just a question of when do they release it. All right, let's go back. Guys, this is all about you. So if you have questions, post them, ask them. I am out of questions, and I'm going to go to what I wanted to cover. We did the payment calculation demo. All right, earnest money. I'm getting a lot of questions about earnest money. So let me, first of all, take a sip of water. Okay, earnest money. Earnest money is the money that you are paying to the escrow company. Escrow is the neutral third party. So if you think for a second about when you were a kid and you wanted to trade baseball cards with a friend and you said, you know what, here, I'll give you my, these 2 baseball cards for that one baseball card that's worth a lot more money. And you go to switch. Well, you don't want to hand your 2 to the friend because your friend will run off with all 3. And your friend's not going to hand it to you because you'll run off with all 3. And so you go find a teacher. And you say, teacher, will you take my 2 and his 1 and swap them? And so that's called a neutral third party, a disinterested third party. That's the job of the escrow company because the seller doesn't want to sign over ownership to you until they get their money. You don't want to give the seller money until you get ownership of the property. So that's what the escrow company does. The title company works in tandem with the escrow company. Typically in Southern California, that's 2 different companies. In Northern California, it's 1 company handling both parts. But the title and escrow services make sure that everybody gets what they expected at the end. And you're going to give that money to the neutral third party, the earnest money deposit. Your realtor is going to tell you you need money up front. And you're going to say, no, John King said I can buy without any cash. That's not true. So you have to have earnest money. But if you're doing the option where we're financing in all your closing costs, you get the earnest money back. But the key is you still have to have the money to give to the escrow company. For many people, we're seeing them do that as a gift. Okay, we're seeing them get a gift from a family member. The easiest thing to do is to have the family member write the check directly to the escrow company, or have the family member wire the money directly to the escrow company. We can have a letter signed later that says it's a gift letter. Typically the escrow company is going to want a third party authorization because the money is coming from someone that is not a party to the contract. But that's the easiest way to do it if you don't have the money. Do not use cash. Don't take cash to go down to the corner store and buy a money order or a cashier's check. We have to prove where the earnest money came from. Okay, so it's critical to understand that. Let's go back. I got 2 more questions. Let's keep them coming. Let's see here. I got 3 more questions. Okay, so my first one is from Beauty. Would CalHalf allow me to rent out the house after 2 years of living in the home? They can't stop you. They don't want you to. If you call them and say, hey, CalHalf, can I rent out the home? They're going to say, yeah, could you refinance first? Now, you notice they didn't say no. They didn't say you can't refinance the home. I know Kathy's worried about the cats. So yes, it is definitely a spoiled kitty, Kathy. All right. So they didn't say you can't rent out the home. They want the money back to go to somebody else. They're going to guilt you into saying, oh my gosh, don't you want somebody else like you that was a first-time homebuyer to get the property? This really wasn't to be able to use the money. This really wasn't designed for rental properties. So you should refinance out of it. Should. Maybe. I mean, I don't know. Shouldn't. Like, that's a personal opinion. Beauty, they cannot stop you from renting out the house after 1 year. The rule says you must occupy the property. As a matter of fact, the rule says you must intend to occupy the property within 60 days. And you must occupy within 60 days and intend to occupy for a year. Now, if your job transfers you by, sorry, I'm seeing this comment in here. So F Sharp is saying release the kitty. Okay, I like that. All right. So if your job says 6 months after buying this house, hey, we have the promotion of a lifetime you've been waiting for. You're moving to Texas. I can't. I have to stay in my house for a year. No, you don't have to stay. You committed fraud if you planned on moving. If you bought this house today and then 6 months from now, you came to me and said, John, I need 3 months from now. 3 months from now, you came and said, John, I've outgrown the house. It's too small because we just had a baby and we can't live in a 1 bedroom, 1 bath apartment or 1 bedroom, 1 bath condo. I need a bigger place. And we'd say, well, hold on a second. Last I checked in junior high, I learned that it takes about 9 months from the time you have the baby working backwards to know that you were going to have a baby. So you knew that you were going to have this baby when you signed this paper that said, I intend to occupy for a year. That's fraud. You bought the house under false pretenses. That's a problem. You're not going to be able to get another loan on another property. And technically they could require you to pay off or sell the house that you're in. So be careful about committing fraud. It is not fraud to rent out the house after a year because all you agreed to is that you intended to occupy for a year. Fulfill that intention. Don't play games with it. But if you got the dream job in 6 months and you had to move to Texas because nothing said you must occupy. It said you have to intend to occupy. And if you didn't know you were getting that dream job when you bought the home, you didn't commit fraud. All right. By the way, I'm not a tax guy either. I said earlier, I wasn't an attorney. I wasn't a real estate agent. I'm not a tax guy, but I will tell you, you need to be careful about capital gains. And one of the best things about owning a home is the fact that you get an exemption from capital gains. Now, what does that all mean? It means that when you make money, the government wants a piece of it. Like every time, not only when you made $1, I was reading something the other day on social media and it said something about, gosh, I earned $1 and the government taxed me on it. And then I used that $1 to go pay taxes, to go buy gas, and I got taxed on that same $1. Like I'm paying taxes 3 times on the same $1. Okay, the government wants their money and they're going to get their money one way or another. Except when it comes to home ownership. You get the current law, not a tax advisor, not playing one on TV. I guess I'm playing one right now on YouTube. But the current law says you as an individual person can have growth in your property up to $250,000 and you pay 0 taxes on it. You could make $250,000, $250,000 on the increase in value of the home, and you get that tax-free for an individual. You can have growth of $500,000, half of $1 million, and you get it tax-free if you are a married couple. The rule, though, says you have to have occupied the property for 2 of the last 5 years. So that's part of her beauty says, can I rent it out after 2 years? The answer is yeah. And the cool thing is, as long as you sell it within 3 years after that, you get to exclude your gains up to those numbers. But if you keep it for 2 years as your occupied property, you move out and rent it out for 3 years and a day, and then you sell the property, you don't get the tax-free money. So it's important to pay attention to that because that's a huge amount of money that you could save or that it's going to cost you by paying capital gains or not paying capital gains. All right. Maria says, what do you think the average home price is going to be amongst voucher winners in the capital region and other regions? Do you think there'll be a good number of new vouchers created via savings? That's a tough one. I see a lot of people that are buying nicer homes because they have a voucher. So I see a lot of throughout the whole state, like in certain markets, LA, San Francisco, pretty much everybody's going to use the 150 grand. Central Valley, Capital Region, Inland Empire, rural areas, you're going to have a lot fewer people using it. The average, it's tough to say. I think Calhaffa gave an average last year. I'm going to take a look super quick. I know they gave a bunch of slides that I took pictures of. I'm not going to look because I can't access it as easily. I'm not going to bore you while I stare at my slide, at my images, but I think there'll be a decent number of vouchers. I think that you're talking about, I don't know, Maria, I know you're trying to calculate as I do about, hey, what are the statistical chances that somebody on the wait list is going to get to the top? I don't know. I don't even want to guess at this point. I'll tell you that what I'm seeing right now in the Central Valley and in the Capital Region is people buying at the price range between $600,000 and $700,000. A lot of them are. I got a fair number of people that are looking in the $400,000 to $600,000 range, but a lot more are buying in the $600,000 to $700,000 range. So I'm not sure that helps answer your question, but it's the best I got. All right. Sun says, I'm waitlisted number 15 in Riverside County. Congratulations, but I'm looking for closing on August 16th. Is there any possibility to find out if I can select the voucher? Okay. Maybe that's not good news. There's no way to know if you're going to get a voucher. You could be number one and you could wait 2 months before you get picked because it's about somebody else clicking the button to say I withdraw. So in the meantime, now technically, as I think somebody was talking about, earlier, maybe it was Maria, was talking about, will they, if you have 3 people that close escrow using $100,000, will they automatically give a new voucher because there's $150,000 that's been upgraded? It's been allowed or unused. That's a better way to say it. Maybe, but it's either that you're waiting for that to happen, or you're waiting for somebody to click the button to say, I quit, I give up, I'm not going to try anymore. And I am super worried that you literally have 31 days, 30 days in July, 31 days or 32 days to get a voucher, lock your interest rate, because you can't lock until after you have a voucher, and close escrow. And before you can close escrow, it's got to get through underwriting, because underwriting needs to know if they're underwriting it without Dream for All or with Dream for All. And then it's got to go to Calhaffa for processing. By the way, Calhaffa impressed me this morning. I think they worked over the weekend and they caught up. They had 0 loans in file. That's been my number one concern, is how long is it going to take Calhaffa in their backlog? Well, we're 2 weeks in and they have 0 backlog. So I'm very, very impressed. If anybody at Calhaffa is listening, props. Okay. Great job on that. Soon I'm worried. I'm worried about Son. I'm worried about your chances of dropping that much. I mean, I had somebody, and I'm sure some of you are on here that might be able to tell me, but I had somebody, I think in LA. LA has the most, like 425 vouchers, and they dropped 12 spots in the last week. That's a pretty good number, but it's still not even 2.5% of the number of vouchers that are out there. And in Riverside County, I'm looking at my calculation, says the Inland Empire only has 187 vouchers. So you need 10%, just shy of 10% of the people to drop out. I think they will. I don't think they will before August. Well, I don't know if they will before August 16th. I'm not saying no, but I'm saying I'd be very, very worried. If I was your lender, I'd be very nervous about your ability to make it there and for them to be able to close that on time. I wish I had a better, clearer answer for you, but that's the best answer I can give. All right, I don't have any more questions other than about my spoiled kitty and having to release the kitty. So I'm going to go back to what I had prepared, and then I'll come back with any questions that you guys have. Again, this is your time. Okay, gift money. Lots of people have been saying, John, I want to put more down, or they said, hey, I didn't want to put any money down until I realized I can't buy the house at the price that I want, and I need to stretch my buying power. One of the ways to stretch your buying power is going with option number 3, in the options I described, which number 3 is you pay the extra 5% out of your pocket and the closing costs. But here's another way to increase your buying power. Pay off debt. Paying off debt. We don't care how much money you spend to pay off debt. We have to prove where it came from. You can get a gift. Now you have to find somebody willing to give you a gift. But you can get a gift from a family member that you can use to pay off your car loan. You could refinance your car loan into a family member's name, so the car is no longer in your name. You can refinance the car yourself into a longer term, especially if you're halfway through your 5-year car loan or your 6-year car loan, stretch it back out to 5 years. Sure, that's not a good financial decision, but not getting a house and not using the voucher and not gaining any equity and not getting any tax write-off is not a good financial decision either. So you have to weigh the pros and the cons. Small decisions that hurt you, that help you accomplish big decisions that help you, are a good thing. And so thinking about how you can reposition and reuse your money, thinking about how we can stretch your money by paying off some debt, by increasing your credit score so that you're over 700 instead of below. Things that you can do when it comes to gift money is numerous, but you have to handle the movement of money properly. You have to make sure that we are documenting it properly, because if it's not done properly, your loan could get denied. And you do not want that to happen. You want to make sure, ideally, all gifts should go from the donor directly to the escrow company, directly to them. Do not pass go. Do not touch your checking account, because if it touches your checking account, then I have to revalidate all the money that's gone in and out of your checking account. And if you deposited any cash, that's a major problem. So gifts cannot be cash. But here's a dirty little secret. I don't care where the donor got the gift. If the donor happened to have the gift in cash, when the donor deposits it into their checking account and then wires the money to escrow, I don't ask how the money got into the donor's account. So some lenders have what's called an overlay that says they are going to dig deeper into that. We don't. Fannie Mae doesn't require us to dig deeper into that, so we don't. Now, if I send the donor's bank statement and it says the money was just deposited, we have every right to ask, and we have to. But I won't send the donor's bank statement. I won't even ask for it. I don't want to see your donor's bank statement. I just want the money wired directly from the donor to the escrow officer. So there's certain things you have to make sure you're doing right. And if you don't feel comfortable that your lender is equipped to help guide you, start here. Click here, scan this QR code, let me guide you, okay? It is not just about getting the basic understanding of a pre-approval and getting you a voucher. It's about getting you successfully across the finish line. And that's what I'm committed to do. All right, I have 3 more things I want to talk about. General questions, anything you guys have about anything at all, feel free to ask me. If you want to know who's going to win the World Series this year, I'll tell you that too. All right. So I know I have some Dodger fans that watch me, so I had to throw that out there for the fun of it. All right. Do I have one of those Dodger fans right now? Beauty set. No, it's not a Dodger. Well, you might be a Dodger fan, but that's not what it's about. Is there an update for who and when to get an extension on the voucher? No. They didn't want to talk about that 3 weeks ago. And I asked again, and I said, hey, do we have any new information about that? And they said, no. They said, basically, shut up until we announce it. So I'm not sure if they're going to publicly announce it. I'm not sure if they're going to just kind of put it out there to say, hey, add a button on the page that says click here to ask for an extension, and then quietly see if anybody asks for it. It is hard to say. Like they're not being very clear about what they expect, and they're not being very clear about what really they don't want people gaming the system. And I get it, but it makes it really hard for you to make plans. So I would say make plans for the fact that you don't know that if you're going to get an extension, and do your best to get into contract as quickly as you can. All right. Fire insurance. Insurance in the state of California is in crisis mode. Now it's getting a little bit better. From the things that I've been reading, it's been getting a little bit better. Well, part of it's because the state's been allowing for rate increases. So current homeowners have had to have their fire insurance policy and their homeowners insurance policies go up. The state was trying to keep insurance cheap. The problem is the cost for claims have been growing so much that you can't have a company, a for-profit company, that is going to pay out a lot of expenses and not be able to increase the revenue. And so a lot of insurance companies left the state of California, or they wouldn't offer fire insurance in particular regions that are considered high fire risk zones. Recently, the state has approved rate increases, but they've also required hey, State Farm, as an example, I'll give you the ability to raise your rates a certain percentage more than you normally would. But in exchange, you have to agree to offer 1,000 new policies in high wildfire zones. So you got to take on more risk in order to make more money. Let's negotiate. And that's what's happening at the state level. That's a good thing. But in general, we're in crisis mode. So when I talked earlier about monthly payments and figuring out, hey, this is the most that you can spend per month, and that you have to figure out how everything fits into there. And I showed you how to use the payment calculator on my mobile app. If you missed that, go back to the beginning of this video. It was probably about 10 minutes in, and watch it again and get that part. If you watched it once and you didn't get it, go watch it again. It's critical that you understand fire insurance is part of that. You and your realtor should be talking to your preferred insurance guy, gal, and talking about regions or areas that are considered higher risk. And getting a feel, maybe run a quote. You can't run an insurance quote on every property before you write an offer, but you can run a rough quote on one property and say, hey, look up this one. Let me use it as the representative sample of this region and how much the insurance costs are running. So it's important that you have a feel for insurance because it is a major issue. And look at those questions roll in. All right, what do we got? Sun says that too. I'm not sure what you're referring to, but I'm happy that you agree with whatever it is that I'm saying. All right. KSV received a voucher. One of the lucky ones. Congratulations. In the Central Valley, homes here are 500, 600,000. The older homes are more expensive than the newer homes. Yeah, it's crazy. It is. And you know, part of it has to do with neighborhoods and more established neighborhoods. The older homes often have cheaper homeowners insurance as well. So you got to trade that off too, because the newer communities are going to have Melloroos. And so you got brand new homes that they're reselling. And so you don't have all the incentives that the builder is offering, and you're still in competition with the builder. So if you're buying a brand new home, you're thinking about buying a brand new home, you may want to consider buying a brand new home that's recently used, slightly used, slightly resold. Especially when the builder is still building in that subdivision, because the builder can sell it at this price and give big concessions, give big credits towards closing costs, give really low interest rates. You can't get those low interest rates when you're using the Dream for All program. You can't. I can explain that to you later if you have questions. So buying newer homes that are in communities that are still releasing new homes, but buying a resale home in there, you can get a pretty good deal on those. The fire insurance is typically cheaper. The homeowner's insurance is cheaper because they're newly built. They've got better materials. They have sprinklers in them a lot, but you do have higher property taxes. So be aware of that fact. But yeah, the market is crazy. All right. So names of insurance companies. Email me and I can get you connected with some good insurance agents. I don't want to publicly promote anybody in that regard. So shoot us an email. You can contact me. My contact information is everywhere. I'm happy to help connect you with good insurance agencies. Kathy finally has a comment that's not about my kitty. Thank you, Kathy. Does the replacement cost also affect the insurance cost? Absolutely, it does. So there's an RCE, or replacement cost estimator, that the insurance company has to run because we have to make sure you have enough coverage to cover what it's going to cost to replace or rebuild the property. So that absolutely comes into play. All right. KSV says, thank you for sharing all my knowledge. I'm happy to. I say this at least once or 5 times on every one of my webinars. I am a for-profit organization. I have 3 teenagers that I need to send to college, and I am interviewing for the job to be your lender to pay for my 3 teenagers that need to go to college soon. So if you think I'm doing a good job, if you think that I've earned the right to be your lender, please scan this QR code or go to this link right here. I feel like the weatherman, but I'm not really good at what I do because I can't tell which direction I'm supposed to point. I don't know how they do it. Like they're looking over there and they're pointing over there at a green screen. I couldn't do it. I have a hard enough time pointing above me and figuring out which direction I'm going. All right. So I appreciate that. And I am interviewing for the job to be your lender. No ifs, ands, whats, or buts, but I will give everything I can for free. I mean that. I will tell you everything I know. I will help you. I will help you solve problems with no obligation. I'm just hoping that I earn your trust in the future. If it's not today, at some point in the future. If it's not you, it's somebody else that you know. That is absolutely how I built my business. Kathy knows that. Kathy and I have worked together for years, and that is how I'm going to continue to grow my business. Kathy says, if a client thinks that's too high, how do they get verification of the RCE? I'd send it to you. Like the replacement cost estimator is a printout, but it's the insurance company running it. So the fox is guarding the hen house. That certainly is a bit of a challenge, but I believe replacement cost estimators are not actually the insurance company using their own software. They're using insurance industry software that comes up with it. I don't know where it comes from, kind of like I don't know where hot dogs come from, but I eat them and they're good. So I'm not going to eat replacement cost estimators, but they do their job and I don't know where they come from. Just like, I don't think we want to know where hot dogs come from. If you know where hot dogs come from, please do not tell me. I'm positive I don't want to know. All right. No more questions right now. Let's go back here and get wrapping up. Bonus income and second jobs. Lots of conversations right now with clients about bonus income, second jobs. Both of them require a history. A second job has to have a 2-year history of 2 jobs. If you're starting a second job now and you didn't have 2 jobs before, we will not believe that you're in it for the long haul. You have to have 2 jobs for 2 years, or we're picking one or the other. But you can change jobs. If you have a job right now and you're not making enough money to qualify, go get a new job. Talk to me before you do it. Talk to your lender before you do it. Hopefully that's me. You can change jobs. You can change jobs while you're shopping for a home if it is an improvement in pay. It does not need to be in the same industry. Everybody freaks out. Oh my God, John, there are no better jobs in my industry. Then go to a different industry, as long as your pay is predictable. Do not go into car sales. If you were not in car sales already, you go into car sales, it's commission. I need 2 years, maybe a year, at least a year, probably 2, to prove your income, to know how much you're really going to make. But if you are switching from an hourly job or a salaried job to an hourly job or a salaried job, I'm not going to be able to add any bonus or commission or overtime on the new job, but I can use your base pay. So bonus income, overtime income, commission income. Everybody says we need 2 years. We don't need 2 years. We want 2 years. The rule says 2 years of a history of receiving variable pay, bonus income, part-time work. Part-time is different than a second job. Okay, second job is I'm working 2 jobs at the same time. You must have 2 years consecutively working 2 jobs. But a part-time job is variable pay. Bonus income is variable. Overtime is variable. Commission is variable. It says preferred. 2 years is preferred. 1 year is required. So if you have been earning bonus or overtime or commission for a year, I can likely add that income. Now, if that puts you over the limit for Dream for All, we don't want to add it. Don't tell me about it. Uh-oh, there goes my camera again. All right, let's switch my settings because I am tired of this. I love this camera, but I'm tired of this camera. All right, we're switching to this camera. There we go. Okay, so I just got to make sure that I'm looking down at that camera. All right, so bonus income, if you've been doing it for at least a year, you are fine. Let's move that back a smidgen. All right, cool. So that answers that question. I'm going to cover changes. This is the last thing that I've got to cover with you. I don't like how this makes me look like I am bald. So let me get rid. I just don't like it. All right, so there that went. All right, I'm kind of bald, but I mean, not like, I don't like that. I'm okay with this. All right, this is on purpose. This not on purpose. All right, so the last topic I want to cover, and then I've got 2 questions waiting. If you have questions, ask them now because we're going to wrap up. I told my wife I'd be done at 8, and I'm a liar, so I'm not done at 8. I want to get done as quickly as I can. All right, changes to credit and debt are critical. I had a client who bought a car last month, and they want a voucher. And now we got to deal with, well, that car is now part of your debts, and that's part of your monthly payments, and you qualified not for a purchase price. That's my theme of tonight. You are not qualified for a purchase price. You're qualified for a monthly payment. And that monthly payment is actually a payment for all of your debt. And if you add extra debt, then the amount that can go towards your house went down. If you get rid of extra debt, the amount that, I'm still looking at the wrong camera. If you get rid of extra debt, the amount that can go towards your house goes up. So changes to your debt matter, okay? Talk to me soon. If you're on the wait list and you say, oh my God, I think I changed some things on my debt. I don't know how it's gonna impact me. Now is the time to do it. If you are a winner, you should be talking to your lender or talking to me to figure out how to deal with that. And remember, a hard credit report is good for 4 months from the date it is pulled through the day you get your keys. So once you pull it, you're locked in and you're golden. And we're not gonna look again at what we're going to look at your debts. We're going to see if you added new debts later. We're never going to look at your credit score again. But even once we pull the credit, we're still going to look again at the end to see if you added new debt. So be aware of that fact. All right. let's finish out here with general questions. All right, general questions. All right, this one's not a question. So Daniel, you're very welcome for the valuable information. I'm supposed to look there, not there. So I appreciate that. The last question I have, guys, if there's more questions, ask them now. Yassine says, can you talk about new construction low rates? I can. Okay, so with a new construction home, the builder is trying to get you to buy their property. And they know that the biggest issue right now that people are dealing with is interest rates. They're freaking out. I don't want to buy a house because rates are high. So builders are smart. And they said, you know what? We're going to buy from a specific lender a bundle of loans, a bunch of money. We're going to buy an armored truck, and we're going to prepay for that armored truck worth of mortgages to get it to a lower interest rate. And that armored truck worth of mortgages was bought from a specific mortgage company. It's called a forward commitment. They've committed to delivering X number of mortgages within a period of time, and they wrote the check to buy down that rate. In doing so, it stays off of the radar of your transaction, which makes it compliant for that lender to have the builder buy down the rate by so much money, okay? So normally you've got limits on how much the builder can pay towards closing costs. But in this case, that's a really weird fuzzy thing over my shoulder. All right, maybe that's better. So the difference is, the key thing is that armored truck worth of mortgages was bought already from their preferred lender. And their preferred lender has to use their conventional funding source, not Cal Halfa's Dream for All source, their own conventional funding source. So to get the Dream for All money, you have to get your primary mortgage from Cal Halfa. Even if your builder's lender says, I can do Cal Halfa for you, I can do Dream for All for you, and they can. But they can't give you their low rate, because that low rate is for the lender's bucket of money that the lender will be servicing. Cal Halfa's bucket of money is serviced by Cal Halfa. Cal Halfa sets the interest rates, and they cannot buy down that rate. So the only thing that you can get from the builder is closing cost incentives, and only if most of them are tying it to using their lender. And so only if their lender participates in Dream for All, that's the only time when I tell you I am not the right lender for you, okay? If you are buying new construction and your builder is offering a closing cost credit, only if you work with their in-house lender and their in-house lender does Dream for All. I want you to leave me. I do not want to do your loan. I want you to come back to me when it's time to refinance. You have to pinky swear that you're going to spend all of your friends and family and relatives and people you hate, everybody you know, has to come to me. That's all I ask for. But I don't want you to do the loan with me. Why would you walk away from a big closing cost credit if you can get it? So that's the key with low interest rates. So hopefully Yassine, that helps answer your question. Alejandro, I'm on the waiting list, number 242 in Santa Cruz County. My lender thinks I have a good chance of getting a voucher. What do you think? So 242 in Santa Cruz. Now, Santa Cruz is not part of the Bay Area. It's part of the Central Coast. By my calculation, there were 306 people on the waiting list for 102 vouchers. So let me share my spreadsheet again. Let me make it bigger. Let's do it this way. There we go. All right. So by my calculation, I don't think I'm that far off. You had 102 winners in the Central Valley. Excuse me, in the Central Coast. So that is all the way down to Ventura County, all the way up to Santa Cruz County. Okay. And of those 102, you're number 242. That means that you have 343 people in front of you. Okay. All 102 that got their voucher and the 241 that are in front of you already. All of those 343 people need to, let me rephrase that. 102 vouchers have to make their way through that many people. I don't see it as a good chance. Now, I will tell you that that region is going to be hard for people to use their voucher. I believe that it is really hard in that market because it's sparsely populated. There aren't as many homes out there, and a lot of the region is very, very expensive homes. And so it's hard to find a home, but you can drive to Hollister, you can drive into King City, you can go over the hill, there's lots of people who are that live in the Central Coast right now and are willing to drive over the hill. Okay. So in Santa Cruz, you got a lot of areas you could go that may be less expensive, that I think people are going to use that voucher. But I do think we're going to see more fallout in the highest cost areas, the entire coastal region. Okay. San Francisco, Central Coast, Los Angeles, Orange County, and San Diego. We are going to see higher fallout. But CalHFA themselves said, hey, we're doing 3 times the number of people on the wait list instead of 1 time, because we don't want any chance that we're ever going to run out of people on the wait list. Well, you're number 242. And I don't mean to say, I'm just answering the question directly. I know this isn't what you want to hear, and it probably doesn't feel good. And I'm not trying to be mean. I'm trying to be clear. You're number 242 out of my calculation of 306. So when CalHFA said we wanted to make it so big that there was no chance that we were going to get to the end of the list, and you're pretty close to the end of the list, CalHFA doesn't think it's going to get to you. I wish I could. I wish I thought differently. I don't. I mean, I think your lender is giving you positive feedback and encouragement. I don't think it's likely to happen, and I wish that wasn't the case, but unfortunately, that's my opinion, and I'm always going to tell you the truth. So, guys, that looks like all of the questions that I have. I really, really appreciate it. I am going to put back up my little work with me thing. So work with me, okay? I'll even point this up a little bit so it doesn't look like it's cutting off my head. Anyway, I really appreciate you. I really appreciate your trust. I really appreciate the opportunity to guide you. If you believe that you will be better served by working with me, I am honored to give you the opportunity to have the opportunity to help guide you. So if you want to have a conversation, we can schedule a call. You can email us and just schedule a phone call. You don't have to start the application process necessarily, but we can absolutely have a conversation. Alejandro, I appreciate that response. Again, I wish that I had a more positive outlook, or not outlook, a more positive thought about where you're going to end up. But again, I'm going to tell you guys the truth. So I appreciate everybody staying this long. I appreciate you listening and trusting me to guide you. And again, I'm interviewing for the job of being your lender. So please scan that QR code or go visit johnloneking.com. And I would love the opportunity to guide you. Again, thank you for listening. Have a good night, and we'll talk to y'all soon. Bye-bye.